Let's remind ourselves of the accounting equation. Assets equal liabilities plus equity. So if I've got assets and Walmart as of January 31st, 2013 has assets of $203 billion, Walmart had to get the money from somewhere to buy those assets. One source of financing to buy assets is liabilities. So what's a liability? We kind of have a sense that liability is an obligation, but let's get the technical accounting definition of a liability. Liability is an obligation that will require a probable future sacrifice of economic benefit. So probable future sacrifice. It's not certain. Sometimes, for example, environmental liabilities are a good example. If a company has done some damage to the environment, it's probable that that company is going to have to fix that in the future. How much exactly, we don't know, but you can estimate an amount that's probable that they will have to pay. That's a probable future sacrifice. And that sacrifice is going to be in the form of transfer of assets or providing services. So let's take a look at this. An obligation. When a company has done something, so now it is obligated to provide assets or services in the future. Even if they don't know for sure, if they can be reasonably estimated, then it's going to go as a liability in the balance sheet. So you don't have to know the exact amount. Environmental liability, again, is a good example. You don't have to know the exact amount, but if you can do a reasonable estimate and you've already done the thing that creates the obligation, boom, goes as a liability on the balance sheet. Now, a liability can be an obligation to either transfer assets or to provide services. And let's take a look at one of these examples right here at Microsoft. It says unearned revenue. When you buy software from Microsoft, you're actually paying for two things. You're paying for the software itself. Boom, you got that. And when Microsoft sells you that software, they also typically say, and for the next 18 months, we promise to give you upgrades, or we promise to provide you service. Or we're giving you two things. We're giving you the software right now, and we're giving you 18 months worth of upgrades or service. In other words, Microsoft is on the hook to provide a service in the future. That's a liability. That's an obligation. It's called unearned revenue. So an obligation can be either an obligation to pay money or an obligation to give a service. And a liability has to be as a result of a past transaction or event. You can't say, well, it looks like next year we're going to use some electricity, so I'll report that as a liability now. No. Unless I've already used the electricity, I don't report the liability. So the event that caused the obligation has to have happened in the past. So when I look at a company's balance sheet and I see liabilities, all those liabilities have resulted from events that happened in the past. But again, accounting doesn't just look at the past. The fact that it's a liability right now means it is saying, that amount is saying there's a probable future sacrifice. Accounting is not a history lesson. Accounting is telling us what's probably going to happen in the future. Probable future benefits, assets, probable future sacrifices, liabilities. Now some common liabilities. McDonald's, for example, if you look at the balance sheet of McDonald's, they have some accounts payable. McDonald's buys, a common business arrangement, McDonald's will buy supplies from its suppliers and say, we will pay you later in 30 days or 40 days or whatever it is. Those are called accounts payable. When a company buys inventory supplies from a supplier and just promises in standard business practice, we'll pay you later. Put it on our bill and send us a bill. Microsoft, we already saw, has an obligation to deliver services in the future for software upgrades and software maintenance for, say, 18 months after you buy the software from them. That's an obligation to provide a service. We call that unearned revenue. ExxonMobil owes taxes of all sorts to many governments around the world. Sales taxes and income taxes and property taxes. And in the notes of their financial statements, they list all the taxes that they have to pay. Some, they've incurred the obligation, they haven't paid them quite yet, so they would list that as taxes payable. Disney and many other companies, including Walmart and ExxonMobil and all these others, have obligation to repay some long-term loans. Borrow money to finance purchases of some assets and promise to pay it back in the long term. You list that as an obligation in the balance sheet. So there are lots of different types of liabilities. Here are some examples.